Peter Rose, Longwood Currency Trading. It's a beautiful summer day in August of 2022, and I wanted to discuss something that I had an email about this, and the person was asking me about staging issues. And I want to bring it clearly out that Forex lot staging reduces position profit. For this person, I did we just ran a quick math example out. In a situation where we were trading multiple lots, full lots, and we went all in and came all out at the end of the whatever the period was, that how many ever pips the profit target was away, the position profit was $2,400. Taking that same ultimate lot size, we staged in different ways, and you realize that the sooner that you stage in, the more you're going to lose if the price turns around and goes against you. For example, if you stage everything in at entry and it turns around and goes against you and you have a 10 pip stop and you're trading 5 full lots, 50 bucks a pip, you've lost $500. But if you put, let's say, of those 5 lots, you put 2 of them in at entry and then stage 3 in, and you lose. Well, you're only losing then on 2 pips times 10 lots. 2 lots times 10 pips, 20 bucks, $200. And the other 3 haven't been brought into play yet, because by the time you bring that other 3 in, you've bumped your stop up to break even, so your loss now is relegated to those three lots. So you could lose 8 pips on those 3 lots and gain 3 pips on the 2 and have a net loss of maybe $100 or $50 or something like that. So you're managing your risk by staging, and so staging enables you to increase the safety through risk management of your position, right? However, when you stage lots in, regardless of how you stage, as long as it's not all in, all out, you reduce the overall position profit. So in the example that I worked out for this particular person, we went all in and came all out, and there was a $2,400 profit. And yet when we did the staging, most of the safe staging, where you don't end up with stage 2, stage 3, it goes against you and you lose 5 anyway, the profit dropped to $1,500. That's a pretty dramatic drop in that staging. And the thing was, we started with I think the example is the second example we did was with 10 lots, and we splattered those in over 50 pips, about every 8 pips or something like that, and that reduced the $2,400 to the $1,500 level. And so you have to understand this, is that the reason that you're reducing that profit is because every time you stage, as you stage a lot in, you're raising the average position value, right? So if you go 8 lots in at 1.000, then your average position cost is 1.000. If you go in with 4 lots at 1.0000, and then you go in with another 4 lots at 1.0010, in other words 10 pips up, your average price is at 5 pips up. So you've raised the average price. So the price is currently at 10 pips above the initial entry when you stage the second 4. And when you do that, your average now becomes 5 pips. Well, price is currently at 10 pips, and so that means that if price goes down 5 pips, then you are a break even. If it goes down 6 pips, you lose 1 pip on 8 lots, right? And so in order to protect that, as you stage, you want to make sure that you're not pulling that average price up so close to your current price that you're in danger of a small retracement or just a quarter of an ATR dragging you out of the game. Because the whole point of staging is to ultimately make more money over the long run than you would if you would have just traded 3 lots. You're adding to that position to bring it up to 10 lots. So obviously, whatever that average value is, minus the current price level when you close, it's multiplied by 8 or 10 lots as opposed to 3 or 4 lots that you would have brought in. By adding safety to the position growth process, which is what staging does, you reduce the profit. And isn't that the way that it always is? If you want absolutely safe money, you buy a 10-year T-bill at 3% a year, 3.25%. I don't know what it is today. Let's say it's 3.25%. If you want to take on a little bit more risk and go into an index fund, you may get 8 or 10%. If you go in and buy an individual stock, you may lose 40%. But then again, you may make 12% on that stock over the year. So the more safety that you build into something, the less your profit potential on that is, the less your return is going to be. The more risk you're willing to take, the more you should be able to gain by that. Now, don't understand the dynamic of the investment itself, the inherent riskiness or safety of that investment, then it's going to be very hard for you to calculate the value of taking that risk over not taking that risk. And that's in anything, whether you're doing stocks or commodities, or old tires, cars, real estate, doesn't make any difference. This is a key thing, and it's called estimating the value of the thing that you're doing. What's the value of a slice of bread over an ounce of gold? Well, there's a whole lot of gold that is going to make that at this particular time $1,800 for an ounce of gold, and for the slice of bread it might be 3 or 4 or 5 cents. So how do you compare those two investments? Well, you have to go on the use of that investment. In the long run, if there was a famine, that slice of bread might very well be worth more than that ounce of gold. And then again, because of the scarcity of bread, the ounce of gold might be worth more, because then you could buy the bread at prices that maybe somebody else wasn't able to afford. So there's a balance between risk and reward that you have to be cognizant of in your trading, and it particularly comes into play when you start staging. If you're just all in, all out, if you're trading a couple of minis or a couple of full lots or something, you're not staging those. You're trading even 3 full lots. You're really not staging those. You could go in with one and then stage one and another one, but because you're dealing with such a small bank, a $30,000 bank on 3 full lots or 3 minis, whatever you want to do, you're trying to maximize the amount of profit to help that position grow. So that's why the tendency of us is to just push the envelope on that 1 full lot or that 3 lots and just try to get as many pips as you can out of that to make the account grow. You're not going to exacerbate your problems by staging, because staging is going to reduce the amount of profit that you're ultimately going to make. Even though it's going to be perhaps safer in the long run, it's still going to reduce your profit. So where's the balance between when you stage and how much you stage and the areas that you stage in? Doesn't make any difference unless you have an account size large enough in order to get involved in that. And then you better get some consulting as to how you're going to go about that. I mean, it's a complex analysis, a complex study that goes into doing these kinds of evaluations. I mean, I've written computer programs on staging in and staging out. I think I've mentioned that in a couple of other videos that I've done. And I'm able, because of that, to take a matrix of staging possibilities. I go in with 3, add 2, add 1, add 4, add 3. Go in with 5, add 2, add 1, add 1, add 5. All those kinds of permutations become very complicated from even from a calculation standpoint, because for every lot that you add in, it's not a linear thing where you have, well, if I'm just going to go in with 5 lots at the opening and let it run, there's only one permutation that you can have of that. You go all in. But what if I go 5 and 5, or if I go, I go 3 and 2, or what if I go 2 and 3? How about 1 and 3 and 2? Well, if I go 1 and 3 and 2, then I could go 3, 1 and 2, or I could go 2, 1, 3. So there's 15 different possibilities if you're going to stage over 3 stage periods. So if you're getting 3 stage periods, you have 15 different possibilities. If you're going to stage in over 5 different levels, that's 325 different permutations you can put those staging elements in. Now, I mean, if they're all the same, then it's then I mean, if I stage in 5 and then I go 1, 1, 1, 1, 1, 1, I'm not really, I don't really have, you know, if I do that five of those periods, I really don't have 325 different possibilities. I really only have 2, right? But even with 2, I have 4 ways of doing it. I go all in 5, or I go in 1 and 5, or I go in 5 and 1, or I go in 1. So it's all in how complicated you want to do your staging that's going to change that average position value, right? I mean, if I stage in 3 and then stage 8, that's going to suck that average line right up, almost right next to where the current price level is. If I stage in 6 and then I stage in 2, it's not going to move the needle on that too much. If I stage the 2 very close to the 8, the needle will move and it'll bring it right to that current price. If I wait 10 pips or 15 pips to stage the 2 in and I've got 8 down here, it's not going to move the needle that much and you're pretty safe. But you have the risk of the 8 down here. So the balance of the thing is, or the thrust of the conversation, is to show you that when you start thinking about staging, you're reducing the amount of profit. And that's why I don't suggest that if you're getting started in your trading, if less than 300 trades or less than, I don't know, $30,000, $50,000 or something like that, trading 3 to 5 full lots, that you even think about staging. Because you're trying to go all in, all out with your 1 full lot. You're trying to maximize the amount of profit. Why would you break that down into 10 mini lot stages? Why would you do that? Because you're just reducing the power that you have in your hand. It's only when you get up to the point where you're trading a $50,000 or $80,000 account or a $100,000 account that you are you should be very hesitant about taking $50,000 and doing an all-in, all-out. Because if you've been trading 1 full lot for a long period of time and building your profits up so that now you've got $50,000 and all of a sudden now you trade a $50,000 account and you've got a 10 pip stop, you're losing $500 on that trade, where if you were doing a 10 pip stop on 1 lot, you'd lose $50. So you're increasing your loss by an order of magnitude by increasing your lot size, and so it becomes really problematic in staging, and I really don't suggest that. So there's a lot of you folks that are watching this that are trying to get started on a couple of mini lots, and there's a lot of folks that are watching this channel that might have a couple of $100,000 account or $50,000 account, and they're interested in basically what I'm doing. And there's a lot of folks that are in that, I don't know, 5 mini lots to 2 or 3 full lots. That's the target group that I'm working for. That group that's in the 4-figure to low 5-figure account size, trying to work their way to build the account so that they can ultimately get up and get to a 6-figure account and trade that, because trading the 6-figure account is different than trading a one full account, one full lot, right? And so the purpose of this video was to make sure that you understand why I suggest all the time that you don't mess around with staging unless your account is about 30 to 50,000, so you're trading 3 to 5 lots. And again, I'm assuming US 5% margin down, which a lot of you are not encumbered by. If you're overseas, you may you may not have that kind of margin. You may be trading at 100 or 200 to 1 leverage, which I think is crazy. I don't think you should be doing that. That's my opinion. If you pay me money to read my books or do consulting, you're going to be very disappointed that you don't see me doing or advising you how to duplicate what some of these jackass educators, so-called educators, are doing. Oh, I made $20,000 today. Oh, okay. You were at 200 to 1 and your account size was $3,000. Yeah, you could probably do that, but you could also lose the whole account. And so to try to duplicate that is crazy. And the guys that are doing that generally wipe their accounts out and go away, and they just add more money and they keep going and they pretend like everything is okay. Everything's not okay. So please be very careful about how you approach this. Don't try to do this on your own. Find somebody that you trust and get some advice as to how to work your way through those early growth stages of the 4-figure account sizes, trading mini accounts, mini lots, to the low 5-figure account sizes up to maybe $20,000, $30,000, so that you're gaining your skills correctly and you understand the dynamics of price action and the effect that your profit target has on where your stop is, right? And then once you start asking yourself those questions, you can see that there are tools out there, compounding, staging, negative staging, all these different tools that you have that you can say, oh, okay, now I'm going to start to do X, Y, Z. Well, you better not start doing X, Y, Z until you put a lot of study into that, because again, when you start doing a lot of these things, if you invert the order, for example, if you're staging and you do a upside down pyramid and you go, I go in with 1 lot, I go in 2 lots, I go in with 4 lots, I go in with 8 lots, you're screwed. I mean, you can just see that. So there has to be, and staging is the more dangerous of the exotic methods of trading. I mean, I include compounding into that. I mean, compounding, the risk of compounding and failure pales in comparison to if you make a mistake in your staging. So in any event, just be aware, don't be afraid of the fact that, or negative towards staging, that you're going to reduce your overall profit, because you're staging so that you can get more juice, more wood on the fire, so that when you get to your profit target, hopefully that average value of your staging has enabled you to magnify the number of lots that you've staged in. I mean, look, if you stage in 4 lots and then you stage in another 4 lots, your price goes up 2 pips and you close the position, you might make 30 pips on the first 4 lots, but you're only going to make 2 pips on the second 4 lots. So why bother to take the risk of staging the 4 lots in if you're going to get out right away? I mean, there's a way to do that, and that's a method that I use. Although I tend to be a little impatient, I want to get all the wood on the fire as early in as I can, and that catches me many times. You can lose a lot of money, and you can go underwater a lot by doing that. I'm in a situation right now where I'm underwater in an open position by an enormous amount of money because I did that. I got all my wood on the fire. I misinterpreted the momentum factor. It went in my favor. It bounced back. It started to go back in my favor. I loaded in another lot instead of waiting for the stage points to come. I thought, well, I'm pretty confident that this is going to do the bounce routine, and it's an opinion. And you know, I should save my opinions for movie reviews because every time I do that, I run into trouble. So if I run into trouble doing it, what do you think is going to happen to you? I've been studying currency markets since 2007 and actively trading since 2012. What are you going to do? So take my advice, learn from my mistakes, and don't learn from yours. Okay. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.